So you want to know the secret to how the ultra-wealthy live like kings while paying zero federal income tax. Most people ask me for the secret to getting rich, and I tell them the simple truth, but almost nobody believes me because it sounds too boring. They want a hot tip or a new meme coin or a lottery ticket, but the real answer is just boring math mixed with a bit of legal wizardry. Imagine a founder who started a company 30 years ago when the shares were worth pennies on the dollar. Now those shares are worth over $50 million. And if they sell even a tiny percentage, the taxman takes a massive bite out of their life work. So they do something else entirely that most regular people have never even heard of in their entire lives. It is called the buy, borrow, die strategy, and it is the primary reason the top 1% stays at the top of the food chain. I am going to break down the logic for you today, but honestly for most of you this is not the right move for your current bank account. But knowledge is power, and understanding this will change how you look at every single dollar in your pocket from now on. The whole game sits on 3 basic rules of the tax code that seem ordinary until you stack them together like bricks. Rule number 1 is that you only pay capital gains tax when you actually decide to sell the asset to someone else. If your $50,000 portfolio grows to $500,000 over 20 years, you have a huge unrealized gain. The IRS calls this a realization requirement, which basically means if you do not hit the sell button, they cannot touch your money. Rule number 2 is even simpler because borrowed money is never considered taxable income by the federal government. When you take out a loan for a house or a car or even against your own stocks, the IRS does not see it as a paycheck. Rule number 3 is the absolute kicker called the step-up in basis, which happens automatically when you pass away. If you die holding those shares worth $500,000, your heirs get them at that new high market price. The $450,000 of gain you made during your long life is just erased from the tax books forever. Under Section 1014 of the code, this applies to stocks and real estate, and even that rare art you hide in the basement. Everything resets to the fair market value on the day you die. So the tax bill basically disappears into thin air. Now let us talk about where you keep your money, because the account type is more important than the investment itself. Most people have 3 buckets, starting with the regular brokerage account, which I call the tax now account. You get a 1099 every year for dividends and interest and capital gains, and you pay up to Uncle Sam immediately. Then you have your 401k or traditional IRA, which is the tax later account where the bill is just waiting for you. You get a tiny break now, but the government is just waiting to tax every single cent you take out in the future. Finally, there is the tax never account, like a Roth IRA, where you pay tax upfront and never have to worry about it again. But here's the catch, because the step-up in basis only applies to that regular taxable brokerage account. It does not work for your 401k or your traditional IRA, and your heirs will still owe the taxman a fortune. So the big players build their real wealth in brokerage accounts or real estate to keep this strategy alive and kicking. Instead of selling their assets to buy a yacht or a steak dinner or a new house, they just borrow against them. They use something called a securities-backed line of credit, which sounds fancy, but it is just a loan using stocks as collateral. Big banks like Fidelity or Schwab or JP Morgan will let you borrow 50 to 70% of your portfolio value. If you have $1 million in stocks, you can basically tap into a massive pile of cash without selling a single share of stock. The interest rates are usually tied to something called the Secured Overnight Financing Rate, or SOFR. As of April 2026, that rate is around 3.6% plus a little extra for the bank's profit. You might pay 5 or 6% in interest, but that is often much cheaper than the 20% you would lose in taxes. There is no fixed repayment schedule, so you can carry that debt forever and just let the underlying portfolio grow. Since the loan proceeds are not income, you owe zero tax, and sometimes you even get a tax break on the interest you pay. But here's where the strategy really shows its teeth when you finally head to the great beyond and leave it all behind. The loan gets repaid by your estate, and your heirs get that sweet step-up in basis on the remaining assets. They sell a portion of the stocks at the new high price to pay off the bank, and they owe zero capital gains on that sale. You spent $1 million of the bank's money while you were alive, and nobody ever paid a single tax on the growth. The Yale Budget Lab says this allows lifetime income to completely escape taxation, which is absolutely wild if you think about it. Now, you might be thinking that this is only for billionaires, but the rules are actually getting more flexible for the rest of us. The estate tax exemption is now $15 million for individuals and $30 million for married couples. That means for almost everyone watching this, the big downside of holding assets until death is completely gone. The government also kept the capital gains brackets at 0 and 15 and 20% for the foreseeable future. And here's a pro tip, because the 0% bracket is way more generous than most people realize. In 2026, a married couple can have nearly $97,000 in gains taxed at 0%. You do not even need to borrow money if you just harvest your gains slowly during your low-income years. You get the same benefit as the billionaires without paying a single penny of interest to a greedy bank. But do not get it twisted, because playing with debt and the IRS is like playing with fire, if you are not careful. Risk number 1 is the dreaded margin call, which happens if the market crashes and your portfolio value drops too low. The bank will call you and demand more cash immediately, and if you do not have it, they will sell your stocks at the bottom. Suddenly, the strategy you use to avoid tax triggers a massive tax bill at the absolute worst possible time. Risk number 2 is interest rates, because these loans are variable and can go up much faster than you expect. What felt like a cheap 2% loan a few years ago might cost you 7 or 8% today. Risk number 3 is that the law can change, because Congress is always looking for more money to spend on things. Just because the rules are great in 2026 does not mean they will be the same in 2036. Risk number 4 is that compounding interest can eat your returns if you are not earning more than you borrow. If your portfolio grows at 7% but the bank takes 6%, you are only making 1% in real terms. A bad recession can wipe out your margin of safety and leave you underwater with a huge debt and no way out. The truth is that even for the top 0.1%, this strategy is usually just a tool used at the margins. They get 99% of their income from dividends and rentals and only use this for extra spending money. The big takeaway is that the account you choose matters just as much as the stocks you decide to buy. If you are still using spreadsheets to track all of your finances, you are living in the Stone Age and begging for a mistake. One wrong formula in a single cell can turn a successful retirement plan into a total financial disaster. I personally use professional planning software to model out these scenarios and check my probability of long-term success. It helps you see the future without the guesswork, and honestly, it keeps me from doing stupid things with my capital. Before you ever think about borrowing against your stocks, go talk to a real professional who knows your specific situation. The question is not whether you can pull this off, but whether it is actually the best move for you and your family. Most of you will find that simpler strategies like gain harvesting give you all the benefits with none of the stress. Understand the rules that the wealthy use, but only apply the parts that actually make sense for your own life. Every unnecessary luxury you buy today is just you firing a hard-working employee who could be earning you compound interest. Stop trying to get rich quick and start trying to stay rich forever by being patient and rational with your choices. The market is a device for transferring money from the impatient people to the patient people, so do not be the one paying. If you enjoyed this deep dive, go check out my other video on how to pay zero tax on $100,000 of income. The math is always there for you if you are willing to look at it and stop listening to the noise. Most people will work their whole lives and never understand why they are still struggling despite a high salary. It is because they are playing a game where the rules are written for someone else entirely. When you understand how debt and taxes work together, you stop being a pawn and start being a player. Billionaires do not have some magic wand, they just have a longer time horizon and a better understanding of math. You can do the exact same thing if you stop chasing the next big thing and start respecting the power of time. Compound interest is the eighth wonder of the world, but you have to stay in the game to see it work. Every time you sell out of fear or greed, you are resetting the clock and letting the government win. The buy, borrow, die strategy is just one way to keep the clock running until the very end. But even if you never borrow a dime, just holding your winners and avoiding taxes is enough to change your life. Wealth is not about how much you make, but about how much you keep and how much that money grows while you sleep. I want you to be the person who owns the assets, not the person who is owned by their liabilities. Think like an owner and act like a partner in the global economy rather than just a consumer. The world wants you to spend every dollar you have on things that lose value the moment you buy them. Resist that urge and put your money where it can actually work for you and your future generations. If you stay disciplined and follow the logic, you will look back in 20 years and realize it was the best decision ever. Finance does not have to be complicated if you strip away the ego and the fancy words. It is just about being less stupid than the other guy and staying in the game longer. I am here to help you navigate those waters so you do not have to sink like everyone else. Check the links below if you want the tools I use to stay on track and keep my math straight. Building wealth is a marathon, and most people quit at mile 5 because their feet hurt. Be the person who finishes the race and enjoys the view at the top. Wealth is waiting for you if you have the stomach to wait for it. Stay boring, stay patient. Peace.